All right, let's dive right in. Today we're going to unpack a really important and, let's be honest, kind of tricky part of Canadian tax law. It's called the tax on split income, or TOSI for short. Now that name might sound a little intimidating, but I promise, by the end of our chat today, you'll have a solid grip on why these rules exist and exactly how they can affect a family business.
So here's how we're going to break this all down. First, we'll look at the why, the big advantage that makes income splitting so tempting in the first place. Then we'll get formally introduced to TOSI, which is basically the government's answer to this strategy. After that, we'll roll up our sleeves and apply everything to a real-world case study, which is where it all starts to click. And finally, we'll wrap up with the key takeaways that you really need to remember.
Okay, so first things first. Before we can understand the solution, which is TOSI, we have to understand the problem it's trying to solve. Why would a business owner even want to split their income with their family? What's the big prize they're chasing?
And you know, this question really gets to the absolute heart of it. On the surface, it seems like a no-brainer, right? A simple way to lower the family's overall tax bill. But this exact move is what the tax on split income rules were designed to block. The reason why? Well, it's all about how our entire tax system is built. The bedrock of this whole conversation is Canada's progressive tax system. I like to think of it as a series of buckets, or maybe a staircase. As your income fills up the first bucket, it's taxed at a low rate. Once that's full, the next chunk of your income spills into the next bucket, where it gets taxed at a higher rate, and so on. So, the more you earn, the higher the tax rate is on that last dollar you bring in.
And this is where you can really see the temptation in black and white. Look at the left side, one person earning a big $200,000 income. A good chunk of that money is going to be in those high tax buckets. But now look at the right. If you can legally split that same $200,000 between two people, they each only have $100,000 of income. They both stay in the lower tax buckets. The result? The family as a single unit pays way less tax overall. That's the game.
Now, I gotta be really clear about something. The government isn't against all forms of income splitting. Not at all. In fact, the tax laws specifically allow for some strategies, like making a contribution to your spouse's RRSP. So there are legitimate, perfectly legal ways to do this. The rules we're talking about today, the TOSI rules, are like a laser-guided missile aimed at very specific situations. So if some splitting is okay, how does the government decide what's not okay? Where do they draw that line in the sand? Well, that brings us to their big weapon in this fight, the tax on split income, or TOSI. So there's the textbook definition for you, but what does that actually mean in plain English? It means that if you try to shift certain types of income, usually from a private business, to a family member who isn't really involved, the government steps in with a special punishing tax that completely wipes out any benefit you were hoping to get. You might hear some older tax folks call this the kiddie tax. For a long time, that's basically what it was. It was designed to stop business owners from sprinkling dividend income to their little kids who obviously weren't running the company. But, and this is a huge but, in 2018, the government massively expanded these rules. Now, they don't just apply to kids, they can apply to adult children, spouses, parents, pretty much the whole family. And this quote right here, it just nails the why behind the whole thing. The government is trying to stop business owners from paying dividends or other amounts to family members, what the CRA calls non-arm's length parties, who haven't genuinely earned it. If they haven't put in the work, taken a real risk, or invested their own money, the government says they shouldn't get the tax benefit. So what's the punishment if you get caught by these rules? Well, it is not a slap on the wrist. It's more like a tax sledgehammer. Any income that gets classified as split income is taxed at the absolute highest tax rate possible in your province. It doesn't matter if the person receiving it has no other income. Bang, top rate. All those potential tax savings, gone, poof. Okay, theory is great and all, but let's make this real. The best way to understand these rules is to see them in action. So let's walk through a pretty classic case study involving a family business. This is where the rubber really meets the road. So let's meet our players. We've got Brody, the dad. He's the one who does all the work, running his successful lawn care business. Then we have Oscar, his 15-year-old son. And, of course, we have the business itself, which Brody has set up as a corporation. A very typical setup. And here's the plan. Step 1. Brody sets up the corporation. Step 2. He issues shares, one for himself and one for his son, Oscar. Step 3, and this is a key detail, Brody pays for both shares. Oscar doesn't put any of his own money in. And finally, Step 4. At the end of a profitable year, the company pays a dividend to both of them. It seems simple enough. So this all leads us to the million-dollar question, or the dividend question anyway. How does the Canada Revenue Agency look at that pile of cash that just landed in Oscar's bank account? He's 15, he didn't do any work, he didn't invest any money, what happens now?
All right, let's put on our tax detective hats and figure out what happens to Oscar's dividend. And I'll warn you, it's a little bit of a head-scratcher at first, because we're not just doing one tax calculation here. We're actually doing two, side by side. Okay, so your first thought might be, wait, shouldn't that dividend income just get taxed back in Brody's hands? We have these things called attribution rules that usually do exactly that when you give money to a child to invest. But, and this is a big exception, those rules generally don't apply to dividends from a private Canadian company. So legally speaking, that dividend income belongs to Oscar. It stays with him.
Now, here's where it gets really weird. For Oscar's regular, normal income tax calculation, something strange happens. The dividend goes into his income, and then it's immediately deducted right back out. It's like it just flows through his tax return without touching the sides. The net effect on his normal taxable income is zero, nothing.
This table does a great job of showing the two parallel universes this dividend lives in. On the left side, you see his regular income calculation. Dividend in, dividend out, net impact is $0. But on the right side, that's where the action is. That same dividend becomes the star of a completely separate, special tax calculation under the TOSI rules.
And there it is, the hammer. In that separate TOSI calculation, that dividend income gets taxed at the top marginal tax rate. It doesn't matter that Oscar is a teenager with no other income. The rules pretend he's a top income earner and tax him accordingly. The whole benefit of shifting that income into his low tax bracket completely vaporized.
And just when you think it can't get any worse, it does. The government adds a little insult to injury. You know all those normal tax credits that help reduce your tax bill, like the basic personal amount that every single Canadian gets? Yeah, Oscar can't use almost any of them against this special tax. The only real breaks he gets are the dividend tax credit and, if you were eligible, the disability tax credit. That's it.
Okay, so we have been deep in the technical weeds there for a minute. Let's pull back up to 30,000 feet and look at the big picture. What does all of this really mean for a family that owns a business? So what's the bottom line here? It's actually pretty simple. The TOSI rules worked exactly as they were designed to. By taxing Oscar's dividend at the highest possible rate, the government completely neutralized the tax advantage the family was hoping for. At the end of the day, the family pays pretty much the same amount of tax as if Brody had just taken all the money himself. The strategy accomplished nothing.
And this really leaves us with the big, lingering question. We've seen how the rules work in a clear-cut case, but in the real world, it's often much fuzzier. What if a family member does some work? How much is enough? The rules are incredibly complex, with all sorts of exemptions. It really forces us to debate where the line is between clever, legitimate tax planning for family business and what the government considers an unfair scheme. It's a fundamental question, and it's a debate that continues to have a huge impact on how family enterprises in Canada are structured and run.